Income Tax 2020 tax software example, itemized deductions, taxes you pay. Come in, relax with Income Tax 2020. Here we are in our Intuit tax software. You don't need the Intuit tax software in order to follow along, although I do believe they have a 30-day free trial, so if you can get a demo version of it to practice with, that could be a good tool to use. We're going to be focusing in on the Form 1040 and the related Schedule A. We're going to be jumping back and forth from the data input to the forms so we can run different scenarios. The tax software helping us to do that more easily. This is going to be our starting scenario. We have a single taxpayer, Eric Smith, living in Beverly Hills, 90210, 100,000 on the income, 12,400 standard deduction to get us on down to the taxable income, 87,600. Seeing this on the Excel worksheet, we have the same layout, or now we have the same layout. The income, we have the standard deduction because it is now greater than the itemized deduction, and that gives us down to the taxable income of the 87,600. We're going to be focusing in on the itemized deductions, remembering here that we got to be over the standard deduction in order to take the itemized deduction. That for a single tax filer will typically be the 12,400, and if married, it would be the 24,800. We're going to be focusing specifically on the state tax, which is a significant impact and can be one of the contributing factors to push someone over that threshold, although the state tax will typically be capped at 10,000. So it's not going to get it there in and of itself, but it can be obviously a big chunk to push someone over to that threshold. So let's take a look at that first. We're going to go back on over. We're looking at the Schedule A here. So within the Schedule A, we're looking at the taxes that are paid. When we're thinking about the taxes paid, we're not thinking federal income taxes. We're not thinking any of the federal taxes, Social Security, Medicare, or federal income tax. We're thinking state and local taxes that might go here, primarily the state and local taxes being the primary form of tax for the state, which would either be a state income tax for, say, like a California, or a state sales tax that you could then have. Those are going to be the big ones that you would think would be considered in the tax line item. Then you might have taxes, the second big one, property taxes, often on the home, which could be significant. So once again, the taxes typically will not be the thing pushing people over the threshold. What will typically push people over is when their income goes up. They might buy a home, which means they would have the home mortgage interest. Added to that, possibly the property tax on the home, which could be a significant impact pushing people over the threshold. Also note that these state taxes are something that the tax software can often help out with. For example, we have the 1,060 here. I didn't input the 1,060. The software automatically checked this box, which says, if you elect to include general sales tax instead of income taxes, check this box. Why did the software do that? Because I don't have anything in there with the withholdings for the state income taxes, so the tables that it could use were higher, and the software said, hey, I'm just going to basically calculate based on the sales tax tables, considering the fact that that's the highest amount. So this is another area where the tax software, especially if it's a state income tax, will be useful, or if you're using these sales tax tables for the actual software to help you to do those calculations. Software can also help with cutoff calculations in terms of when you made the payment. So remember, we're kind of like on a cash basis. So the software is going to help you to determine the payments that were made in the current year in 2020 and the payments that were made in the prior year. And if you roll over the tax return from one software like Lacert, if you roll it over from 2019 to 2020, it'll help you with those cutoff calculations. So we'll take a look at those in more detail shortly. But if I go back on over to my data input, for example, and let's start off with the type of tax that's most common, W-2 tax, right? We got withholdings on the W-2. Now, obviously, as income goes up, if you have a state tax that's an income tax, then the state taxes will typically go up because it's going to be a progressive system. In a similar way, they'll kind of mirror the Fed typically. So the state tax, however, is not something that will be calculated because they might use a progressive system as with the federal withholdings. So that just like with the federal withholdings, it would be reported on the W-2. The federal withholdings would be shown as something that got taken out of the wages, meaning the employer took them out of the wages. Same with the state if there's state requirements for the withholdings. So let's say we put here 7,000 that was withheld. And so I'm just going to say, and that would come straight from the W-2. Now that was actually paid. It wasn't paid by the taxpayer directly. They didn't write a check to the government, but the employer took it out of their pay based on the W-4 that they filled out and paid it to the government basically on their behalf. So that's going to be basically thought of as a payment by the taxpayer. And there's the $7,000. So now this box is not checked because now we're going to be doing the state taxes. In the California return, you could see the calculation of the California return. But remember, this number is going to be based on the amount of payments, basically on a cash basis. So this is what actually came out of the W-2, and that's why it's going to be included here. If it was too little, then we're going to have to pay some money with the state tax return, and that probably won't happen until 2021. And the payment that we made, although it will be applied to this 2020 return, wasn't paid until 2021 and therefore wouldn't be deducted until the 2021 taxes. If, on the other hand, we are overpaying the tax, then we're going to get a refund. The refund will happen next year. We'll get the refund back in 2021, and we will have over withheld here. And if we got a deduction for it on Schedule A, we may have to include the refund in income. Not because it's income, it's a refund, but because if we got a tax deduction for it, then we'd have to include it in income. Now let's put this over the 10,000 to see the limit, to see the cap applied. If I go back on over here and I say, well, let's put this over to 12,000. So let's say we withheld 12,000 and come back over to the forms. Now it said, okay, we withheld 12,000 and it capped it at 10,000, so we only got the 10,000. That's the cap. Now, what if we were married here? If we were married, let's check that out. We're going to say client information, and let's say we're married, and we're married filing jointly. So now they got married, and we're going to go back on over just to check the cap here. And I'm going to go, no, we're still not itemizing, but let's just check out that cap. If I go to the Schedule A, we still have the cap of the 10,000. Even if we had the spouse earning wages as well. So if we say plus, and then I say employer 2, and this is going to be the spouse earns another 100,000, and we had state taxes withheld of 10,000, and I go back on over, then we still have the cap at 10,000. So whether single or married filing joint, you got this cap on the taxes here of basically that 10,000. Let's go back to single. I'm going to go back on over and say, all right, so I'm going to delete that. Say yes. Let's go back to single. I'm going to go back to single as our default position. So here is that. And so I'm going to go back on over, and it's still capped then at that 10,000. So if I go back on over, it's still capped at the 10,000. Okay, so that's not you. It can't push you over, even if you're single, over the threshold for the standard deduction, but it can be a significant chunk. And then the other thing that could push people over, of course, is if they have the home. So let's add the home interest, which is the typical thing that'll push people over. So if I say, okay, let's add the home interest here, and anytime someone has a home, they would probably have a loan on it. They would get a 1098 form for the interest on it. Let's say it was for $6,000 of interest. And then you'd probably have taxes. Now we're talking not the taxes for the income taxes, but the property taxes on the home, which could be on the 1098, or it might be something that you have to gather separately. But anytime someone owns a home and therefore has a 1098, typically if they have a loan on it, then you're going to think property taxes and make sure that you're picking that up in some way, shape, or form. Again, you're typically thinking about the taxes that were on a cash basis. They were paid then in the year is the general rule. Let's say that's another 3,500, and so then I'm going to go back on over, and now of course we're over the threshold to be itemizing. We're at the 16,000. That's over the threshold of the 12,400. And therefore we would be itemizing here. So the taxes in and of themselves may not push us over, but the combination could. Now I'm going to bring the withholdings down from 12,000. So I'm going to say the withholdings oftentimes are, might not be 12,000. Let's bring the withholdings down to like, let's say 2,000 on the withholdings, just to bring them back into reason. So we got the 2,000 withholding, 3,500 on the state and local taxes. Now then you could think, okay, what if I elect to be taking the taxes not on the state taxes for the income tax for the state, but rather the sales tax. Now again, if that was the case, if you didn't have an income tax, then just like what we started with, if I went over here and didn't have any state tax withheld on, say, the W-2, the software would typically do that calculation for us, right? The software is going to say, okay, I'm going to use the tables for that. Now you can also go back to the Schedule A data and force the sales tax. So then I'm going to say, I want you to use the sales tax calculation. And then again, the tables will typically be like the default, or you can enter basically the actual sales tax. So if I went here to sales and use tax and said the sales and use tax was 2.5, let's say, and then I'm just doing this just for an example. I won't go into detail on the breakout of the actual sales tax, but that's going to be your option, right? So now it's brought it up to the 2005 instead of what it was before by default. In other words, if I remove that, then it's using basically the tables, bringing it back to 1060, going back on over. I'm going to remove this, and I'm going to go back to my data input on the W-2. And then again, if we had withholdings, then that would be an indication, of course, that you're in a state that has basically state income tax. And then now it's picking up the income tax because that's greater than what the sales tax would be by the tables. Now just realize again, if you overpaid the state taxes, so let's say the W-2 on 2020, you had withholdings of $2,000 for state taxes, and that was higher than your actual state tax calculation. When you look at the state tax calculation, you will get a refund then. And you might think, well, then I deducted too much. What am I going to do? I'm going to get a refund in 2021. Shouldn't I only be deducting here on the form the amount of the actual tax or the amount paid? And the way the IRS is going to fix that is basically they're going to say, no, take the deduction on a cash basis generally, and then when you get the refund, you may have to include it as income. So you got an itemizing here, and we talked about this in the income section. Then when you get the refund in 2021, you might have to include it here in part 1 for tax refunds on line 1, but only if you're getting a benefit from the tax deduction in the prior year. In other words, you would have had to be itemizing, which we're not at this point in time, right? You would have had to be itemizing, and you would have had to taken advantage, or you would have to have benefited by the deduction for the state taxes. Let's go back to the 1040 here. So we're at the standard deduction now, 12,004. Itemized deductions, that 2,000 doesn't quite bring us over. Let's bring us over. I'm going to go back to the itemized. I'm going to go back to Schedule A. I'm going to go back to the interest, and let's make it 8,000 on the interest. So that'll bring us over to be itemizing. So now we're going to be itemizing here 13.5. Okay, so that looks good. Now then, of course, down here, you might have some other taxes that may be deductible. One of those might be like part of taxes, including your automobile fees might be included down here. Those are typically minimal taxes, but and you should be only including the taxable portion of the automobile fees. But that's typically something that you could pick up and ask about if the taxes are something that could be deductible as well. Okay, so now let's think about a situation. Well, what if we are a Schedule C type of business? So if we're a Schedule C type of business, I'm going to remove this. Then we're not going to have, I'm going to say, let's remove the wages here and say we have a Schedule C business. So I'm going to say, let's delete the wages, and I'm going to say, okay. And then let's say that we have a Schedule C business, and we're going to put the 100,000 there. So 100,000, that's where our income is coming from. And if I go back to the forms, so now we have in the 1040, we've got our 100,000 here, and we've got this above the line deductions on Schedule 1, and that's going to be our self-employment tax and so on. So now, how do we make payments on that? Well, we would have to make estimated payments throughout the year. We're not going to have them paid automatically for us. We would have to make estimated payments. and that's what would determine the payments that might be deductible then. So let's put the estimated payments. And so we might have federal payments, and then we might have state, the state payments. Now this field, these estimated payments, are typically going to be something that we'll put together in the prior year. So if you rolled over the tax software and you have a Schedule C type of client, you probably told them part of the planning is to say, hey, these are your estimated payments you need to be making so that you're paying throughout the year. And then this field will automatically be populated, at least showing you what the payments should have been. And then you can double check with the clients if they made them. So let's say we made these payments. I'm only looking at the state side because the federal side isn't deductible. So if I put something over here, that's a withholding for the Fed, which is going to be on the second page of the 1040, but it would be like a withholding on a W-2. It's not going to affect the actual tax over here. It might be something deductible on Schedule A if we can take the deduction on Schedule A. So I'm going to say we had, let's say 1,000 each month. We'll say 1,000, and this was on 04/15/20. So they paid it in 2020, 1,000 quarter 2, and this was paid on 06/15/20. Let's do that again. Amount 1,000. This I'm not going to populate. And this is going to be paid on 06/15/20. And then 1,000 for quarter 3. And this was paid on 09/15/20. And then 1,000 for quarter 4. Paid on 01/15/21. And let's go ahead and check that out. So if I pull this over then, 4,000 paid to the state in total. Going then to the Schedule A, that didn't put us over the threshold, but going to the Schedule A, then notice only 3,000 showed up here. Why did only 3,000 show up here? Because although that fourth quarter payment was applied to 2020 taxes, it wasn't paid until 2021. So you got that kind of overlap that you gotta be aware of. You paid this one in 2021, you applied it to 2020, you get the deduction in 2021 when you actually paid it. So that kind of overlap will play itself out. Again, the tax software will help you with that because it calculated it for me. But you got to kind of understand that, or else it'll basically confuse you. Now you also might have had an overpayment from the prior year. Let's say like last year you had an overpayment from the state, like a refund, and then you said, don't give me the refund. You told the state, I want you to roll it over as an estimated payment in the following year. So let's say I would have got a refund, but I told them not to send me a check for $2,000, but rather to roll it in include it with the first quarter payment. Well, then that's something that was paid. Generally, they didn't. It was paid by the refund in the tax year, and that's going to be included in our deduction. So now we've got the 5,000 in the deduction. The 1,000 that was paid in 2021 still not being included. And again, when you roll over the software to the following year, it should pick up that 1,000 that was paid in 2021, even though it was applied to 2020. So you got to kind of be careful of that overlap if it's the first year that you're doing the return, to make sure that you're picking up the right amount of taxes in the proper period, and then hopefully the software will kind of help you out with that. So that's going to be the general rules for the state taxes. So the state taxes here, and I won't go over this, going kind of long, so I won't go over it over here. But again, it's the same kind of thing in terms of entering it into the Excel worksheet. Although for state taxes, you're going to have to rely a bit more on the calculation from the software. Oftentimes, if you're using the tables or if you're using the state taxes for the income tax in order to do the double check. So you can have somebody else basically use the source document to enter into this information, but so the W-2 information you can enter directly here, the withholdings and whatnot, but then you might have to be dependent in the software to some degree to help you out with the cutoffs in terms of the state tax payments, to double check them in our tax formula.